Central banks across the world have increased interest rates to contain spiraling inflation fueled by monetary and fiscal stimulus undertaken in the aftermath of COVID crisis. The current levels of bond yields may offer a good opportunity for investing in fixed income funds, but the big question here is what should investors choose between the constant maturity fund and a target maturity fund? What is the difference between the two, and who should ideally invest in these funds? Let's address all of these questions with Arnav Pandya, founder, Moneyeduschool. Arnav, good evening and welcome to the show. So, a constant maturity fund is very different from a target maturity fund. They are not substitutes for each other. But then let's start with understanding each of these categories. First up, what is a target maturity fund?
Good evening. So, a target maturity fund is a fund which will come to an end on a specific date in the future. So in terms of the time period, you can have any time period for which the fund is in operation. So for example, you can have a target maturity fund which ends in, say, April of 2027. You can have one which ends in June of 2030, 2031, all those things. Now, the main part in a target maturity fund is that a target maturity fund's portfolio will consist of debt securities which mature exactly or just around the date of its maturity. So the maturity of the securities in the portfolio and the maturity of the fund matches each other. The end result is that for an investor who invests in this kind of fund and who holds it till the maturity of the fund, they can virtually lock in the rate of return, which is known as the yield to maturity, because the time at which you invest, the yield of the portfolio, you can ensure that you earn that yield over the life of the investment. So in simple words, a target maturity fund comes to an end on a certain date and its portfolio matches the maturity.
And what are the instruments in which a target maturity fund normally invests?
So a target maturity fund can have a mixture of instruments. There can be government securities, there can be debt, which is bonds and debentures of companies, including, there can be PSU entities which have issued these, there can be financial institutions which have issued these, or there can even be banks which have given these. So corporates, banks, PSU entities, financial institutions, there will be bonds and debentures of these entities too in the portfolio.
Okay, so what about a constant maturity fund now?
So a constant maturity fund is different in the sense that in a constant maturity fund, unlike a target maturity fund, it is most likely, it is an open-ended fund. So there is no end period for this. It can, in theory, go on forever. The important thing here is that the portfolio of a constant maturity fund will hold instruments of a constant duration. Say, for example, it is a constant maturity fund of which holds a 10-year duration bonds or GSECs. Then the portfolio manager ensures that the maturity of the portfolio is such that it has 10-year maturity bonds today. Now, what will happen is that, for example, after a year, if the same instruments are held, then the maturity would be 9 years, because obviously the 1 year has passed since then. So what the fund manager will do is that to maintain that constant maturity, it will keep adding instruments which mature after 10 years. So the average maturity of the portfolio remains at 10 years because that is the constant maturity which the fund manager is targeting. So in this case, unlike a target maturity fund where the fund manager is likely to invest in some instrument and then hold it till maturity, here the instruments will keep getting replaced such that the average maturity of the portfolio is what the target is. So as I just explained, for a 10-year maturity thing, they will keep adding new instruments which mature after 10 years so that the overall average maturity keeps on remaining constant. And that is why it is called a constant maturity fund.
This totally means that target maturity funds has a specific maturity period, and after that particular period, the fund or the scheme, it shuts, it closes down. Whereas in a constant maturity fund, it's always ongoing. So the investor needs to decide the kind of time frame they want to put their money into a constant maturity fund. Is that right?
That is correct. So in a target maturity fund, you normally invest when you have a goal which matches that time period. And when that period is achieved, the fund will return you your money and you will get the money back. But in a constant maturity fund, I mean, theoretically, your investment can stay there forever. So in that sense, it will keep continuing. So in a constant maturity fund, the investor has to decide when they want to take out the money. The idea being of investing in a constant maturity fund is that if you want, say, a exposure to a certain time period of instruments, like say 5 years or 10 years, which is available in a constant maturity fund, then you can choose such a fund because you want that kind of exposure. But the decision to get out of the fund, take your money back, that is dependent on the investor, and they will have to make it themselves and not wait for the fund, because that might, or it will not return you your money automatically.
What kind of a portfolio does a constant maturity fund normally has?
So, I mean, in India, we have a separate category, which is, say, gilt funds with a 10-year maturity. Those are a simple example of a constant maturity fund. So here, I mean, those instruments, you will have instruments which mature around that time period. So around 10 years would be the maturity, but that doesn't mean that every instrument will be of that particular duration. You might have some instruments which are slightly shorter and some which are slightly longer. The fund manager ensures or tries to ensure that the average maturity remains at the desired time period, which has been mentioned in the fund.
Now let's talk about the yield and the return part. In a target maturity fund, as explained by you, the yield at the time of your entry will largely decide your return, and especially if you hold them till maturity. How does a constant maturity fund over here work, considering that you need to decide as an investor, you should know your investment time frame?
So here the whole idea is about the interest rate risk. So in a target maturity fund, if you want to eliminate interest rate risk, you hold it till maturity. However, even in a target maturity fund, you might have periods in between wherein your return goes even higher than the yield to maturity. That is because, say, in the interim period, if rates in the economy start falling, then obviously for that time period, you might see a sudden spurt in the returns and it might go higher than what the yield to maturity is. But if you still hold it till maturity, ultimately it will come down and settle at the level at which you invested. Now, in terms of a constant maturity fund, it is open to interest rate risk, which means that as the rates fluctuate in the economy, as the secondary bond market yields change, you will find that the rate of return here also changes. So here, a constant maturity fund will follow the normal trajectory of the other debt-oriented mutual funds, which is that when rates are falling, you will find that the returns are higher, and when rates are rising, you will find that the returns compress due to the change in the bond prices. So that is a factor which an investor will need to take into consideration, because as the instruments also keep getting replaced, the yield prevalent at that time will also start affecting the kind of return that the fund is witnessing. So in that sense, here the investor has to take cognizance of the fact that there is interest rate risk, and they will have to factor that into their considerations when they are thinking of investing and how long they are going to hold the fund.
All right. So one thing is clear, that if you want to be a part of a target maturity fund, you need to stay put in the fund till the maturity period. I mean, that's the best advice right now for them. But then when we talk about a constant maturity fund in the current rate scenario, is it advisable to have a short to medium term view or medium to long term view?
So, see, when it comes to a target maturity fund, the good part is that now you have such a big choice in terms of which target maturity you want in your portfolio, because so many mutual fund houses have launched a range of funds which range from very short term to more something which is more than 14, 15 years. So that is a good part. Now, when it comes to a constant maturity fund, the thing is that you might not have that great a choice in terms of what is the kind of constant maturity the fund manager is maintaining, because normally uh, some fund which is present as a debt fund, you will find it qualifying as a part of some other category. So it might not be a constant maturity fund in the manner you think it is, unless it's the fund which falls into that 10-year gilt fund. So in that sense, as an investor, you have to ensure that if you are looking at a constant maturity fund, you have your strategy very clear before you invest. That one, what is the constant maturity you are looking for? Two, whether that kind of opportunity is available in terms of the choices in the market. Then three, that what are you looking at when you are investing? Because you need to have an entry strategy as well as an exit strategy ready, because you are investing with a specific frame of mind and with a specific goal. So you know that if this goal is achieved, then that is the time to exit from the constant maturity.
All right, so it's very clear that if you need certainty in your returns and you want to park in your money for a fixed frame of time, target maturity fund is right now the better option for you. But then talking about track records and talking about comparing these kind of funds, should an investor also look at this aspect before deciding any target maturity fund or a constant maturity fund, or there is limited data as far as at least constant maturity funds are concerned?
So see, when it comes to debt funds, one has to understand one thing, that just looking at past returns and all is not going to help you, in the sense that the past is not going to be reflected in the future. Like, for example, see, a couple of years back, if you saw past returns of debt oriented funds, then it looked very good. But at that time, already you were in a low interest rate regime. So the returns which are going to come ahead, that depends on the portfolio which the fund currently has and the kind of yield those instruments have when they are invested in. So in that sense, when you are looking at investing in these kind of debt funds, what you need to look at is the portfolio of the fund and what is the yield that it is currently giving and what kind of instruments are there, because that is going to determine what the returns you can expect in the future. So one should not pay too much attention to what has happened in the past. Look at the portfolio, look at the kind of yield which is there, because say for example you are in this kind of high interest rate environment where now you have yields which have gone up quite significantly over the last 1.5 years. So in that sense, if an investor is putting money into say a target maturity fund at this point of time, their return in the future is going to be higher than what they might have earned say if they're invested a year ago. And that is the main thing which an investor needs to look at, that how is the thing going to play out in the future, and that is determined by the portfolio that the fund has.
All right, so it looks like target maturity fund is a better choice within this particular combination. On that note,